Ever wondered if your investment strategy is as efficient as it could be? Perhaps there's an opportunity you've overlooked, a piece of the financial puzzle that could bring balance to your portfolio. In the ever-changing landscape of finance, keeping abreast of all the available options can be a challenge. But fear not, we're here to shed light on a versatile investment vehicle that might just be the missing link in your strategy. Today, we'll explore an investment vehicle that could add some much-needed diversification to your strategy: ETFs. So, what exactly are ETFs, you ask? Well, let's dive right in. ETFs, short for exchange-traded funds, are a type of investment fund and exchange-traded product traded on stock exchanges. Now, that might sound a bit complex, but think of it this way. An ETF is like a basket full of different types of investments, such as stocks, bonds, or commodities. Here's where it gets interesting. ETFs are designed to track the performance of a specific index. An index is simply a group of investments that represent a portion of the market. For example, the S&P 500 is an index that includes 500 of the largest US companies. So if you buy an ETF that tracks the S&P 500, you're essentially buying a small piece of those 500 companies. What makes ETFs special is their structure. They are traded on exchanges just like individual stocks. This means you can buy and sell ETFs throughout the trading day at fluctuating prices, just like you would a single stock. Yet, unlike buying individual stocks, when you buy an ETF, you're spreading your investment across a range of different assets. This can help to diversify your portfolio, spreading the risk and potentially smoothing out the bumps in the investment road. So, in a nutshell, an ETF is a kind of investment that allows you to buy a wide range of assets all at once, similar to a mutual fund, but with the added flexibility of being traded like a stock. Just like a mixed fruit basket, ETFs give you a taste of many different assets without the need to buy each one individually. Now that we understand what ETFs are, let's dive a little deeper. Exchange-traded funds, or ETFs, are known for their flexibility. They can be bought or sold throughout the day, just like individual stocks. This gives investors more control over the timing of their trades. In addition to this, ETFs are highly liquid. High liquidity means that ETFs can be quickly converted into cash without significantly impacting their price. This makes them an attractive option for investors who value the ability to easily enter or exit positions. Another key point about ETFs is their ability to diversify investments. ETFs typically track a particular index, sector, commodity, or asset class, allowing investors to spread their risk across a wide range of assets. Lastly, ETFs are generally more cost-effective than mutual funds. They tend to have lower expense ratios, which means investors can keep more of their returns. In essence, ETFs offer a simple, cost-effective way to diversify your portfolio. So why should you consider adding ETFs to your investment strategy? Well, the benefits are numerous and compelling. Firstly, diversification. ETFs provide an opportunity to spread your risk across a multitude of sectors, countries, and asset classes. Instead of betting on a single horse, you're betting on the entire race. Secondly, flexibility. Unlike traditional mutual funds, ETFs can be bought and sold throughout the trading day just like stocks. This means you can react to market changes in real time, giving you a significant edge. Thirdly, lower costs. ETFs typically have lower expense ratios than mutual funds, which means more of your money stays in your pocket. Lastly, transparency. ETFs disclose their holdings on a daily basis, allowing you to see exactly what you're invested in. This level of transparency is unmatched in the investment world. With ETFs, you're not just putting all your eggs in one basket, but rather spreading them across a field of opportunities.